Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi folks, this is Aditya and welcome back to another episode of the Capital Mind podcast. Today we'll be talking about passive investing. Is passive investing evolution of markets or is it just another bubble? Is passive investing getting out of hands? In US, the market share for passively managed funds has reached 51%. But what about India? Where do we stand? We'll answer these questions and a lot more in today's show. But let me first welcome Deepak Shenoy. Hi Deepak, welcome to the show.
Hi Aditya, it's great to be on the show again. Lovely evening in Bangalore, and we would love to talk about this subject, which I think is a subject that is a close matter to a lot of people, especially because even at Capital Mind, we used to call ourselves with the tagline active investing.
Yes.
Now we're actively passive at times. So why and what and how? Let's go through the rest of the thing that you have for us in the podcast.
So Deepak, we'll divide this podcast into two sections. So in the first section, we'll try to answer the question whether passive investing is becoming a bubble. And in the next section, we'll talk about how passive investing works and what is the flow of money and how can we do passive investing, like passive, active, passive. So here's my first thought. You know that the market share for passively managed funds in US has reached over 50%. And Japan is actually printing money and buying index funds, right? And ETFs. So do you believe this is leading to some sort of a distortion of capital flows in the market? And some people even say that this is leading to death of a thinking investor. And this is leading to a new class of investors who are insensitive to price and valuation.
So, Aditya, I think there's a lot of interesting things. Let's clarify first what passive investing is. So, if you're talking about passive, you're saying, Deepak, I'm going to buy the top 50 stocks by market cap.
Okay.
We call them the Nifty 50. Awesome. This is great. Why you buy the top 50? Because we believe the top 50 will continue to be very good. What if some of these stocks are not part of the top 50 tomorrow? Well, you sell them and buy the stock that replaces them. Okay. And just always be in the top 50, right? So you're now in the top stocks of the exchange. If you consistently do this, then the stocks that are consistent performers over a very long period stay in the index, give you great returns. You replace the losers automatically, not taking any personal decision on saying, oh, Yes Bank will recover, so I should keep it. No, if the Yes Bank goes out of the index, you take it out of your portfolio. If Yes Bank stays in the index, no matter how bad you think it is, you keep it in the index.
Okay.
You keep it in your portfolio. Now, the point about indexing has been, once you don't have to make these decisions, and these decisions have come out of an algorithm. The algorithm can be as simple as highest market cap.
Okay.
It can be highest earnings. It can be highest. So you can have an index which is based on some kind of mathematical formula. And then have an ETF or an index fund that chases that index, that buys stocks in the same proportion as that index. Now you don't need to think about which stocks to buy. You don't need to analyze the fundamentals. You don't need to see whether this stock has corporate governance issues. You don't need to see. So you're just going to blindly buy the stock.
Okay.
The fact is that this strategy has beaten a lot of active managers over years and years and years.
True.
Simply because this is like in most cases where they're market cap weighted indexes, that's where the maximum amount of capital is. If you have a market cap weighted thing, that means I will always buy Reliance because it's the top market cap. If Reliance falls out of grace, then you will sell Reliance and buy something else. Now, the top stock of the index in every decade has been different. It used to be Reliance. It then became TCS at some point. At some point, it went to ITC, came back to Reliance, came to TCS. So it has actually shifted. The top set of stocks have shifted over the years. Some of them have gone out of the index temporarily and come back. Whatever happens, you're now with the top 50 or top 100 or whatever top level that you have.
Okay.
A market cap weighted index is like a momentum index. You buy more of the stocks that are going up because they're up, and they're up because they have the highest market cap.
Exactly.
Some of this leads into a self-fulfilling prophecy, because if more money comes towards the top set of stocks, those are the prices that will go up.
Exactly.
And therefore, those are the prices that will not go down, because these people are not selling. And therefore, momentum is with those stocks. It builds momentum. You continue to buy or buy more as more money comes into index funds. So there is a perverse incentive over here to not care about fundamentals.
Okay.
That means I don't care. So what does an index fund manager vote for? If somebody gives him a policy that says, I am going to triple my manager's compensation,
Okay.
what should the index fund manager vote? Because he's not like, listen, if you triple your compensation, I'm going to sell your company from my fund. You can't say that. The manager on the other side knows that. He's like, yaar, you can't sell it.
Exactly.
तुम नहीं बेच सकते. I know. So you can tell me, you can scold me. I'll still give you listening, and I will still triple my compensation, because even after tripling my compensation, you can't sell me.
You can't do it.
So who can sell me? The active fund manager. So I start ignoring the passives and giving a lot of bhav to the actives. But at some point, if the active managers become a tiny percentage, maybe 10%, 15% versus 85% is passive managers, I don't even care about the passives, because actives, because if they don't sell, or if they sell, or if they don't buy,
That
it
doesn't
affect
impact me.
you
Yeah,
at all.
exactly.
So you just stop there and say, okay guys, I'm just going to do this thing, and nobody will oppose me. The passive manager has no incentive now to actually vote for or against a proposal. He's just going to say, okay, what is everybody else voting for? Let me vote on that direction. So just keep the least path of resistance and then move on. Now this is the perverse incentive that happens in such mutual funds. And there's also perverse incentives that can help in building up this. So for instance, if I was a dirty, rotten scoundrel,
Okay.
there are a lot of dirty, rotten scoundrels in the market. If I was one, if I were the kind of person who would say, listen, let's do this. Let's take this stock, which is good, but it's not in the index. I will buy out all of the shares in the market as much as I can.
Basically pump it.
So pump it, get other people to buy it, make its market cap, say 100,000 crores.
Okay.
Once it reaches that, you know that within 6 months or 8 months, whenever there's an index reshuffle, they cannot ignore the fact that this company has a lot of shares and it is listed and its market cap is 100,000 crores. Its free float market cap may be high enough, and you know that it will get included in the index.
True.
If not now, 6 months from now, all you do is hold. Now you hold a majority of the non-promoter shares, and you keep pumping the stock up. When it gets into the index, you know that these big passive index funds will buy you.
Exactly. True.
And then you sell to them and walk away with a profit, because they will have to buy and hold at that
Exactly.
point. If there are not enough active managers who will short sell the stock or who will sell the stock and bring the price down and therefore get the stock to be taken out of the index, there is no reason why this stock will ever go out of the index, because index fund managers get more money, they just buy more of the stock. There's no reason for the stock to fall at all. It's only speculators and active investors who will actually truly help discover price. The passive guys will not. So what you said is true, that we are there are sets of perverse incentives. Now, are we there today versus are we there? We're not necessarily there today, and there is no saint in the active management fund industry either, and even they have not done their job well in terms of keeping governance in check.
Exactly. A lot of people have raised this question that whether this is becoming a bubble. But I differ, because I believe if you talk about bubbles, right from the tulip mania to the housing bubble, all of the bubbles were actually fueled by greed. But in this case, this seems to be a natural evolution of markets where investors are realizing that, boss, there is no point in paying top dollar for research, because 99% of these fund managers over the long term are not able to beat index. So here I don't see the greed. So if the greed is not there, then how come is this a bubble?
So, if we were to just say that the selection of passive funds because of performance is a bubble, I think that would be a wrong thing, because at some layer, we do this for restaurants, we do this for our shopping. We look at stuff that has high ratings on Amazon, or we look at Zomato and say which is the best restaurant around me. And those are also determined by other people's behavior and ratings and things like that. You're also going in the stock market and saying, listen, whatever is the highest market cap, which means a lot of other people own it, I'm going to buy that.
Exactly.
So it's just a natural extension of saying, I will go and check all the companies and the fundamentals myself. Here I'm saying, no, I'm assuming somebody else has made a good decision. I'm just going to...
And what is the cheapest form of instrument available to buy it?
Yeah, and it's cheap because while doing so, active managers take a humongous pay. If you look at HDFC AMC's financials,
Okay.
Which is the asset management company, a significant portion of its earnings after it pays out commissions is paid out to its own staff and the managers. Of course, they work hard, they completely deserve their money. But if the mutual fund that they run is not consistently beating the index itself, or a combination of indexes, you begin to question, Acha, if you're not, then why can't I just put a computer, make it buy all the stocks in the proportion of the index and just let me have the index? No
When
fancy
you do
stuff. This, you remove the compensation of the manager, and therefore your costs of the mutual fund company itself become substantially lower. They can obviously lower the costs that are being charged to the fund and earn the same absolute profit. So if I wanted to earn 30 crores of profit, I could earn 100 crores and pay 70 crores to my manager, or I could earn only 30 crores and have no manager.
True.
Which is in a computer. So my fee fell from 100 crores to 30 crores to make the same 30 crore of profit. And effectively I could reduce the net charges. So the bubble has term actually has come in from the fact that there are consequences. And those consequences are similar to bubbles, because when there's too much riding on one part of the equation, you do create an issue. Now, if you look at LTCM, which was a long-term capital management in 1998, it was doing something very simple. It was buying, say, 9-year bonds and selling 10-year bonds, or the other way around, whichever it mattered. The idea was that the 9-year bond and 10-year bond should not differ too much in price. But in reality, the pricing of the two instruments was very different. And that arbitrage gave result to a price differential that was harnessable. So I could say, listen, I can buy one and sell the other. One is 9 years, one is 10 years. At some point, they may come close to converging, and I will result myself in a profit. Now, this is actually has worked out true in Microsoft Excel, if you do a back test and all that stuff. But what happened in reality was a big disaster, not because this didn't work, but because LTCM got too big. If it was so big that it was threatened to bring down the entire financial system in 1997, 98, whenever that was. It was because LTCM was so big that everybody knew that it had these positions, and even if they widened in price even a little bit, then LTCM's entire capital was getting wiped out in just the mark-to-market or margin payments that they were required to do. This is a consequence. It was not a bubble. It was just a mathematical anomaly that what works at small size does not work at large size.
You reach a scale where your actions also influence the outcome.
Yes,
right?
Reflexivity in a way. So in the sense that what you do has a different consequence at small scale and a different consequence at large scale. Now, what happens in passive? Why does it work? One of the reasons it works is because active managers find the right stocks, they pump the money into the right stocks, and then the stock prices go up. These passive managers piggyback on that. They say, okay, you've selected the right stocks. I trust you. I'm just going to buy them blindly. If you sell the stock price will fall. It will fall out of my radar because I'm using prices and market cap as a filter, and then I will, sell it. So, what happens when passive becomes greater than active? Much greater than active.
Okay.
The active manager suddenly realizes that his actions of analyzing balance sheets is stupid, because the money that's flowing into passive
Exactly.
is greater than the money that's flowing into active. So he can sell a stock, the passive manager will still go buy it.
Exactly.
Because there's a lag, no, between the time he can sell and the price falls versus the time that is actually removed from the index. That could be 6 months. Meanwhile, the passive manager, I could sell 10 crores of a stock, its price could fall 5%. The active manager may get 100 crores and buy that same stock, the stock goes back up 10%. So I look stupid. I've lost all my money selling this stock, which I think is bad. The passive manager doesn't care. He's brought the stock price. It's gone up. He feels even more justified in his buying the stock in a way. And everybody's happy. So the stock may actually be bad. There's no price discovery happening here. This is a consequence similar to a bubble.
Okay.
Where in a bubble, people buy too much out of greed and speculatory purposes. Here, the buying too much is not because of greed or speculatory purposes. It's simply that there is so much money sitting on one side of the equation and not enough on the other, that there's no check and balance.
Exactly.
There's the checks and balances system has stopped to work, and therefore it causes a similar action. So when you have indexing reach extreme peak, there will be a point at which it stops working. I'll tell you what point that might be. And that point may be that when index funds become the only things in town, or at least they go more than 75% of the assets, and then people start taking out money. Now stocks will fall for no reason, because now they are 75% of the market, right?
Exactly.
So stocks will fall for no reason. The active manager will say, no, I should buy this now. It's come to a great buy point. But no, money is not coming because more money is going out.
Exactly.
And when stocks fall, people who have lost money take out more money. And they keep taking it out. At which point, at some point, it will take some time for this to happen. The flip has to happen. The active money flowing back to active has to now overshadow the amount that is flowing out of passive, right? But that is not going to happen.
Okay.
Because who will invest in an active manager who is buying stocks as they're falling and their prices are falling even more? Think about it. You bought a stock at 100, it was a stock which was at 200. The active manager refused to buy it. People got out of passive funds for whatever reason. They wanted some money. There was a crisis, a liquidity crisis. People lost jobs. The market starts to fall. Market continues to fall. And this 200 rupees stock has now fallen to 100 rupees. Value manager says, okay, the active manager says, great, now this is the time I'll buy. I'll put my 10 rupees. I know I don't have a lot of money today. I'll put my 10 rupees and the stock will start to perform. But more money is coming out of passive funds. The passive managers are selling more and more. And as they continue to sell, the stock which is 100 has now fallen to 50. The active manager's performance is also bad. So, in a way, what's happening now is the active manager is looking at himself and saying, oh my goodness, I thought this was a great buy at 100. Now, why is it at 50? At some point, this results in such crazy actions. It will result, if it's too big, is that even active managers won't get money and passive managers won't get money. And this is the time when governments will start to act, or RBI will start to act, and so on. And in the West, it's already happening. You're seeing a Japanese central bank print money to buy stocks.
Amazing.
And that is crazy because, they're trying to keep the market afloat in a way. And everybody wants this because they don't want their portfolio values to fall. They don't want their retirement nest eggs to fall. So everybody says, yeah, go ahead, print money. And this is not going to end well per se, but the bubble really is in another phenomenon, which is in the printing of money. Maybe it will outlive me. I'm much older than you, so it probably will. But it may not be that I live long enough to see the end of this money printing exercise, because they can just keep doing this forever. And you will not know, and you will actually tell them that they should be continuing to do this.
Economics.
And, I could be stupid enough to stand here and say, this is not how it's supposed to be done, but it's being done, and the world has not come to an end, and it is being done for the last 10 years. So who's to say that the end is tomorrow? So same thing for passive, So is the end tomorrow? I don't know. Will it continue forever? I don't know. It looks like there is no reason for it to stop as long as money printing is going to exist. Passive may continue to see funds flow towards it. And if funds flow out of it for any reason, the governments will print more money and buy the streams passive stock. So That's where it is.
So, Deepak, let's move to the other section where we try to understand passive investing. So, my question is, as we discussed that the market share in US has reached 51%, interestingly, 10 years ago, passive funds in US were just 25%. So, in 10 years, they doubled from 25% to 51%. But what about India? Like, where do we stand? If you look at the total AUM in India, it's about 26.5 lakh crore, out of which equity mutual funds hold around 8 lakh. Next is the debt mutual fund, around 7 lakh. So these are approximate numbers. Liquid funds, another 5 lakh, and then ETF at 1.77 lakh. So let's focus on this number, ETF, which is 1.77 lakh. Let us add US ETFs that track India. So that is another 1.5 lakh crore. So we can say that total AUM of passively managed funds in India is around 3.25 lakhs. Now compare it with the free float market cap of all the companies listed in NSE. So that will take you to around 5%. So the comparative figure for India compared to US, where they are at 51%, the comparable figure for India is at 5%. So if you talk about a bubble in US, I may agree with you, but India, bubble? Like, I believe this is just the beginning. Like, where is the bubble?
Yeah, that's true. See, the thing that we have to see is, where is this money coming from? Even this 1.7 lakh crore. There is 65,000 crores in the largest mutual fund in India.
Correct.
That is this SBI Nifty ETF. The second highest is Kotak Multi-Cap, which is at 29,000. So it's more than double the second highest mutual fund. The 65,000 crores almost entirely been placed by
EPF, right?
the Employee Provident Fund organization. So it's not retail that's been buying this. It's been institutional buying. A number of other ETFs have a very high assets under management, which is for instance, there's a US ETF called, I think, INDA or INDI, one of them, which actually manages around $6 or $7 billion.
Okay.
Now, $7 billion is 49,000 crores. And if you look at our 6 billion, it's about 42. These two funds, and there's a portion, something called EEM, which is Emerging Markets Index. This has over I think 60 billion or some crazy number like that, of which about 10% I think VWO, one of the two, Vanguard Emerging Markets Index, which has so much, and 10% of that fund is India, which also is about 50,000 crores by itself. So I think 3 or 4 ETFs account for
that 1.5 lakh,
1.5. These are extremely large mutual funds, if you may, have some kind of institutional access. Of course, INDA and India are listed in the US, so the 8 billion number sounds very big, but it's actually really small for most US funds. But having said this, where we are with respect to a bubble size of things would be to compare these instruments to the, like you said, free float, non-promoter market cap of these companies. India's total market cap is 150 lakh crores. Half of that is promoter, 75 lakh crores is non-promoter, out of which 3.5 or 3.75 is in ETFs or in index funds. This is piddly, this is tiny. And if you say that 10% of all index funds own today HDFC Bank, that means HDFC Bank ownership is only 30,000 crores. HDFC Bank's market cap is roughly 7 or 8 lakh crores. And so it's 7 or 8 lakh crores, you're talking that even the highest ranked company, the ETF owns less than 10% of that company. And that is really small in overall, size. And this is all ETFs put together. It's not a single ETF. It's
Correct.
All ETFs put together are a very small portion of these companies' market cap. Now remember, HDFC Bank, if you look at the number of shares that are owned by different parts, foreign institutions as a whole, including the ETFs, actually own a significantly larger share than the promoter themselves. That is, the promoter is HDFC, which is about 24%. So the foreign institutions probably own 55-56% or more of the bank, or 50% of the bank. So it's not really a bubble in any meaningful sense of the word. You know what's a bubble? If you were to describe such things as a bubble, it would be foreign institutions as a whole. Foreign institutions as a whole hold roughly half of the non-promoter market cap in India.
Amazing.
Around half. That means we haven't benefited from our own markets. We used to own all of the non-promoter market cap before 1992. We gave half of that away to foreign investors who were coming in, and now we keep cribbing about some things like LTCG and all that stuff, and we don't really actually purchase stocks in our markets. But the point over here is that index ETFs are not really big in India. It's really small. There's one significant point. Recently, this ETF becoming really big has impacted markets.
Yes.
So we have seen that the last 3 months, I don't know if you've seen the data, and I think we've plotted the data in a graph. AMFI releases daily net inflows into every category of funds. So we look at equity funds as a whole. The last 3 months, that is October, November, and December, the inflows into ETFs and index funds overshadows the amount of money that's come in to equity mutual funds that are managed.
Which is very impressive.
Which is very impressive, because and in December there was a big number, okay, 8,000 crores coming into mutual funds. Everybody was happy, fantastic. You know how much came into ETFs? Just ETFs was 12,000 crores.
Amazing.
So active mutual funds got 8,000 crores and index ETFs got 12,000 crores. I don't know who's putting in that kind of money. It's probably not the EPFO, but it could be. We have no idea. We'll know only perhaps with an RTI request maybe 10 years later. But the point over here is it's happening here slowly, that inflows are overshadowing it. Like even if you took the whole of last year, and the whole of last year is not representative, the whole of last year, mutual funds that were active got about 70,000 crores. I'm talking only of the non-hybrid, not balanced.
Okay.
So I'm just talking about pure equity funds, the per se. They got roughly 71,000 crores in net inflows. Was it gross? It's one of the two. The same number for ETFs was 50,000 crores.
That's very close.
Now, it's reasonably high, because earlier you would have thought, they're only 3% of the market, why should we bother? But the answer is, as flows towards index funds increases, at some point overshadows your regular equity, direct equity funds, you will actually find that at some point this catch up will start to happen, and that may still be a long time away. But all it has to do is get to a point where where these incentives get misaligned, if you may, and things start to move. Now remember, it's not just India; it's worldwide. It could be a combination of MSCI India as an index and the funds that follow it. It could be the Nifty 50 and the funds that follow the Nifty 50. It may be the Nifty 100 at some point in time. But this pressure to for it to become too much or a bubble is really, I think, while it's a while away, it is worth tracking. I'll tell you why also, even if you're an active fund manager.
Okay.
As more and more money comes to to passive funds, why not just buy the top stocks which are relatively heavily owned? No, I'm not saying that that's the only way to do it, but consider that I could buy, say, stock like HDFC Bank. Now, you think that HDFC Bank has a promoter ownership of only 24%. Why do we care about promoter ownership? We say, okay, promoters are not going to sell their shares, right? So it's only the rest of the shares that are liquid that will freely trade in the market. But index funds also don't sell their shares for a considerable portion. As long as they're getting money from the economy, from people who are investing in them, they're going to hold those shares for a long time. Neither are, for a large part, foreign institutions, because they also get money from their investors, so mutual funds, institutions and all that stuff. So it's only a small portion of stocks that get that are freely traded. As more and more money comes to index funds, they have to buy these top stocks. Because they are buying these top stocks, even the active fund managers, in order to not underperform, are buying the same top
Exactly.
stocks.
Exactly.
HDFC Bank is a top held position in roughly 90% of all active large mid cap, and sometimes even in small cap mutual funds. It remains that because these funds realize that, okay, if money keeps going to HDFC Bank, I might as well know a little bit so that I'll also participate in that a little bit,
Exactly.
So if it's 10%, I'll take 10%. So because of this, it actually makes sense for an active manager to simply just chase that performing stock. Now also think about what happens when there's a change. If you change a stock, one stock goes out and the other stock comes in,
Okay.
on that day, there will be a big move to shift out from one stock and shift into another stock. We have traded something like this because the MSCI index, if you see, at some point the India index, there was, I think Kotak Bank was about 3% of the index. We noticed that because of some FII ownership laws, there was a massive shift by MSCI to say, I will take out Kotak because it does not allow foreign institutions to buy. When you take out Kotak Bank from at that time, this India funds had about 25,000 crores. 3% of that is 750 crores. 750 crores was 5x the trading volume of Kotak on any given day.
Okay.
So, given that, you knew that the price would be under pressure. You could guess when, because the index tells you the dates at which it's going to happen. And you go short a Kotak. And then when the selling is done, you go long Kotak again, because there'll be active managers who come and buy, because India is not yet permeated only by passive. So it was an interesting active strategy to track. And it's not necessary that it'll always work. But recently, I think we have seen one case where the government replaced the CPSC ETF constituents, 2 of them, by 3 others. And the 2 which were removed or reduced in weightage fell considerably on one day. And the other 3 stocks rose considerably on one day. And that was just a one-day phenomenon. But it's an interesting play because this action is preceded by has got to happen. And somebody has to sell these stocks and buy some other stocks. And if the amount they buy and sell is significant compared to the stocks in daily volumes, you're going to find that there's opportunity to participate. And there's another one that's coming soon, and we'll talk about it at some point.
So Deepak, the way I look at it is there is a tsunami, and if you are being a contrarian, you should know that you are betting against liquidity, isn't it?
When you say against liquidity, you mean against the passive volumes.
Exactly, yes. And my other point is, today one can be actively passive. The sheer instruments that are available, you can buy a Nifty index, and then you can buy Nifty Next 50. You can buy NASDAQ, then gold ETF, Bharat bond ETF. So there are a lot of ways to do this, isn't it?
Yeah. So the good thing about some of these mechanisms is they give you diversification in a single instrument.
Correct.
Because otherwise, I'd have to buy 50 stocks and I have to keep rebalancing. That's such a pain. I just get a single instrument. Of course, I could use an active mutual fund itself. But as we've seen, a lot of active mutual funds change their colors according to the season sometimes. So for a long time, small cap funds were buying only large cap stocks. Large cap funds were buying small cap stocks.
True.
A lot of this has been regulated by SEBI now. But what that has done is made most of the large cap funds equal to each other. They've given them 100 list of stocks and say, choose among these. Now, choose among these is very easy to say, but, some of them will get it right. Some of them won't. It's just the natural, you get 100 people to choose 30 out of 100. Some of them are bound to be outright winners, at some point. And some of them will be consistent also. So the problem really is now in passive becoming the idea of a single instrument being attractive. Is that now going to be selected as a passive fund or an active fund? Till now, I think distributors have been saying, let's go active. Let's go with, big name fund manager A or big name fund manager B or big name mutual fund A, big name mutual fund B. In the US, already people have started to shift to say, forget big name, forget mutual fund, just go with index, S&P 500, bond index, this, that. So once you get down to that level, it doesn't matter who's managing it.
Exactly.
And you're saying that I believe in the top 50 companies in India. it's a much easier proposition for someone to accept than to say, I believe in this fund manager. We like to believe in people. We are people, right? We want a Virat Kohli all the time. We won't say, I will take the top 10 players of the world at any point in time and I'll bet all my money on those guys. If it's Virat today, it's great. If it's not Virat tomorrow, then it's somebody else. And Kapil Dev was there at some point and he was not at some other point. So how does it matter? But we don't get this intuitively. We like people. We say, oh no, this fund manager, he will sit outside the company 24 hours. He will see how much order going in, how much coming out. He will do addition, subtraction, and he will buy the right stock.
We are wired that way.
We are wired that way. But I think if you were to act and say, listen, boss, investing is not my primary business. Okay, I just want to somehow participate in this fancy thing called the stock market because in the long term it apparently beats inflation. So let me just put my money there. How do I care whether I get 25% return or 22% return or 18% return as long as I am getting that return by participating in the top stocks of India? I'm betting anyway on the top stocks of
India.
And I want to buy the top stocks of India. If that is my objective, just buy that. If I want a bond ETF, what the recent bond ETF is doing is telling us that there's an index called something. That index is, of course, quasi-constructed, but the idea of the index is very simple. I want only India, PSU, Indian government kind of exposure. I don't want risk. There is risk in Indian government exposure. We won't talk about that. But it's giving the illusion of low risk. And this index has been constructed only so that this ETF could be constructed.
Correct.
The ETF has been constructed so that these companies can raise money at a relatively low price. And we're on, so it's just simplicity that drives decision making in passive, which I think is a very elegant point, and it's not to be written down shoddily. Simplicity has super attraction in the longer term. Ask anybody who has 26 mutual funds with them, and after 10 years they're looking and saying, "Yeah, I need a guy who can now figure out who all these mutual funds belong to and why did I buy them." If you ask me, I don't remember. And I had SIP, then somebody told me change this SIP, I changed it, and then somebody else told me change this SIP, I changed that also. Now if I sell all this, I will have taxation, I will have this, I will have that. I don't know why these funds are in my portfolio. But if you buy the top 100, you just keep buying it. They're the same. It's like buying the same mutual fund over and over again, and you just have 2 or 3. That's it. So it's an attractive proposition.
So, Deepa, in closing, I would just like to ask, how do you see things going ahead? Because it took US 10 years to go from 25 to 50. Now, they were at 25. We are not even at 10. So, how do you see this panning out?
Yeah, so, I think coming back to one more point about what you discussed, and we don't have it in India yet. In the US, you have ETFs about everything.
Correct.
You have smart beta ETFs, not so smart beta ETFs, and all sorts of anything. 3x leveraged ETFs.
And I don't understand how come people call smart beta as a passive product.
Yeah, I mean, so what is active is not. So the bond ETF in India is similar to that. It's an active product. They took their active product, made an index, so that, of course, I mean, they will argue that it's not, but it is really. So it's just a selection of stocks based on a criteria that's very, very loose. And the index ETF just mimics it. So a lot of people say, okay, I've created this strategy. I've got somebody to make an index against it. And I will now run that strategy as an ETF. And I will charge you very low fees because it can be run passively. I can say, buy on Mondays, sell on Thursdays. This has worked. So I'm going to call a buy on Monday, sell on Thursday strategy and give it a fancy name saying bomb sort, which is buy on Monday, sell on Thursday, and it's a bomb sort index, and I'm following the bomb sort index. Now nobody will question you, right? So the US has gone berserk on this. It's like what was supposed to be a simple ETF buy an index has now become 17,000 indexes, and so they've got something for everybody.
Correct.
So they've got leveraged ETFs, inverse ETFs, short ETFs, long ETFs, India ETF, emerging market, developed market, non-US, except Canada, that kind of thing.
There are way more indices than stocks in the world.
So we are nowhere there. We have like maybe a few ETFs. All of them, most of them chase the Nifty. There are some which are the Nifty Next 50, some mid-cap indexes, some maybe very few on the fixed income side. There's a 10-year GSEC kind of ETFs. The liquid ETFs are horrible. They pay dividend every day, which is just a terrible way to do things according to me. And very few other real bond or fixed income ETFs. There's some gold ETFs. Having said that, I think we've got a bunch of things to do. We need REITs. We need REIT ETFs at that point.
Correct.
We need good fixed income ETFs. We need indexes around a lot of things that currently don't exist. You've got a little bit in the form of consumption, perhaps in the form of public sector enterprises, but I think not enough. Not many international index ETFs. So there's a NASDAQ 100 ETF, which, by the way, is probably the best performing mutual fund of India in the last 1 year. So about 40% nearly returns, I think, in January to December. But nobody will sell you this because it's an ETF, and the fund of funds has so little as an expense ratio that nobody gets commissions.
Correct.
But it's one of the few low-cost international investing options available, but they're not enough. And once we get enough, that time I can say that, okay, India will get to 25% or 30% or 50%. I believe that in India, we will go down the same way as the US. We will have a hodgepodge of ETFs at some point. One day we'll have a podcast about how to select an ETF among the 7,500 ETFs that are out there. And people will be like, thank God you came out of this. I was so confused, So it's really a matter of time, but I don't think we're there yet. I look forward to it, and I think Capital Mind as an entity would like to play a part in making that happen. Not the confusion, but the clearing of that confusion, and therefore, earning some brownie points perhaps. But the point over here is that, we're way early in this whole game. We're way, way early. It's just so many good things that are ahead of us that the more I think about it, the more I think that, we're in the cusp of a massive change. And as long as the bubble in free money remains worldwide, everybody's printing money, including the RBI. So I shouldn't say we are away from the blame. But because of that, we are likely to see ETFs remain very attractive. And therefore, India will have enough time to play catch up.
Thanks a lot, Deepak. Amazing. Thanks a lot for the discussion. And I hope our listeners enjoyed it as well.
Sure, hope so. I think, we've got, it's a time when, people wonder what this whole passive market is about. But I hope we gave you some context in building all of this out into a thought process that says, listen, I'll go passive. I would personally prefer a reasonable percentage, or more than 50% now, I think, perhaps, of assets, of even my own assets, to be semi-passively managed. You may have one active mutual fund and believe that you are actually active, and people are, no, he's buying HDFC Bank. They're all herds, okay? So they will also buy the same stocks, whose price goes up, and therefore the passive guys follow. Tomorrow the passive guys will come first and the active guys will follow. There is no difference in thinking that, oh, no, this is going to collapse one day and all that. Nothing is going to collapse. And it's perfectly valid incentives, right? Why do people go to IIT and IIM? Not because, they're the premier education places. I don't think people who've gone and studied in some of the other institutions, the facilities may actually be better, the professors may actually be better, but it's not about that. It's the mentality that some of the smartest people in India choose to go there, and therefore as a cohort people keep thinking those are the only smart people in the country, but it's not true. There is no reasoning to say that the good people only exist in IIT IIM, and therefore there's no reason to say the good fund is only passive or the good fund is only active. At some point you can say, I am just going to choose to be among the top rather than the top. And simply because an active fund has fees, you will find that as much larger fees, 1 to 2% a year, you'll find that over time it finds it more and more difficult to beat the index.
Correct.
And therefore, the index rises from the average, which would have been 50% of all mutual funds, to around 75% of all mutual funds. So if you want to be among the top 25%, perhaps indexing is for you. And I'll leave you with this. We'd love to hear your thoughts at Deepak Shinoy on Twitter, Aditya's at Astute Aditya on Twitter, and we're at capitalmind_in. www.capitalmind.in is where you'll find us and a lot of our crazy ramblings. Capitalmindwealth.com is where we have an index strategy that we manage for you with 66% India, roughly 70% top 100 India, 25 to 30% top 100 US, for as low as 0.25%. I know you can do it yourself, but we do it at a relatively low fee. And it's been a phenomenal performer in the last 1 year, thanks to Amazon, Apple, and Microsoft. But do consider that as well. That's my marketing plug for the day. So I'll leave this before Aditya is like, you're talking too much. But yes, thanks so much for listening. And we're happy to be here.
Thanks a lot, Deep.